Genius ebook, audiobook version 3.0. Chapter 1 Basics. What works and what doesn't work in technical analysis from my experience. What works and what doesn't work in technical analysis, every form. This is a list of TA that can be seen in my own analysis. Only the most consistent and optimal. I've been studying technical analysis for 11 years. I've tried just about every form, tested and tweaked them. I blend what works in with my own Elliott wave analysis to narrow the odds to as close as zero as possible, or to turn two possible wave scenarios into one. The basic background of technical analysis is very important when it comes to mastering the Elliott wave. This is how I started before I was able to apply Elliott wave as consistently as I've done. Please listen to this audiobook carefully. If you want to see real-world readings of technical analysis, I suggest checking out the charts at bigcharts.com. Bigcharts.com, a free service, is what I've been using since the very first day I learned technical analysis. You'll see moving averages, RSI, slow stochastics, and more. There's really no need for fancy Fibonacci or Elliott wave software. They're robotic. Only human eyes can accurately read Elliott wave correctly, wasting thousands of dollars if you listen to their lies. They claim a lot of stuff, quote unquote, without real actual results. I have real actual results to back my claims. Anyway, here are the forms of TA that I've studied and how reliable they are as indicators. Max pain. This is a biggie for me every expiration week. Typically, the Wednesday before the week of expiration, there's a reversal of the recent trend. This is when I start to analyze max pain. For example, for the quadruple Qs, I'd look at how many calls versus how many puts are about to expire that week. Say quadruple Q is trading at 42, and there's 10 puts for every 5 calls going up to 43, 44, and 45. There's a good chance of a sizable rally in expiration week. However, if there's for example 10 calls for every puts that are going to expire that week, going from 40, 41, 42 quadruple Qs, there might be a bearish slump that week. This indicator works 70% to 80% of the time. It can be very reliable. The ARMS index, the trend. The trend is calculated. ARMS index equals number of advancing issues divided by number of declining issues. Total up volume divided by total down volume. A value of less than 1 is bullish, of more than 1 bearish. Readings are only about 55% accurate, but extreme readings can be notable. More of a longer-term reading, not 100% reliable. Bollinger Bands. Basically, it involves a stock or index reaching extremes if they touch the top or bottom band. It can be effective at times. The stock or index can ride either band for an uncomfortably long time, about 60% accurate. Visualize the bands, go to bigcharts.com and use setting Bollinger Bands. The bull-bear ratio. Excellent for finding extremes of tops or bottoms. Comparing historical readings, like 1998 NASDAQ bottom and the year 2000 top, can provide eerily accurate results. Essentially, tops are found when there are noticeable excess of newsletter writers that are bullish, and bottoms and bears are in excess. Excess can be 65% bears, 25% bulls, 10% neutral, or vice versa. Just compare the bull-bear ratios for every top and bottom since the 70s, and the long-term charts can be found at bigcharts.com. And you'll notice how reliable it is. It is a very powerful indicator. Japanese candlesticks. They can have reliability during periods of high volatility. The only formations that I see that are fairly consistent are the 3 black crows, the morning star, the evening star, the bullish and bearish engulfer, and the hanging man. Recent lack of volatility in the market has lessened the impact of this analysis. Morning stars don't guarantee bottoms, which is a technician's favorite, but it helps, only 60% of the time. Dow theory. I hate to say it, but it's a watered-down version of the Elliott wave. However, Aaron Elliott was influenced by the Dow theory. The MACD. During periods of high volatility, a MACD that crosses over from negative to positive. To visualize this, go to bigcharts.com and use the setting MACD, M-A-C-D. After turnaround in the stock or index, it can be a strong confirmation. However, during low volatility, accuracy is only 60%. Crossover is when the MACD crosses from negative to positive over zero. To see it, to visualize it, go to bigcharts.com and use the setting MACD, moving averages. Typically, bull markets rise above the 50 and 200-day moving average. When the two cross, intersect on the chart, it can signal a major turn in an index or stock. It spares when the stock remains below either moving average for an extended period of time. Stocks can find major support at the 50-day moving average as it rises. You'll notice this phenomenon consistently. A drop below the 50-day moving average for a sustained period signal a reversal of an uptrend or vice versa. The put-call ratio. The most powerful PC ratio measurement that I've found to be extremely effective is the 21-day moving average of the overall PC ratio. A 21-day that's 0.80 or higher, preferably 90 to 1.00, can signal a major bottom. This one measurement is one big key in my bottom calls. All other PC measurements I've found to be far less effective. The Relative Strength Index, the RSI. Another one of my favorites that have proven to help guide my Elliott wave analysis. It's simple. Engaging a bottom, look at the 3 to 5 year chart of an index or stock, and look at how low the RSIs went during each major low. If the current RSI reading is near or below a major low reading, it can signal a major bottom. It's a consistent indicator. Inversely, it can signal a major top. Again, very effective. The slow and fast stochastics. The fast stochastic is unreliable, at least to me, because it's too noisy. But the slow stochastic that mirrors previous lows in an index are at 0 to 20 to signal a major bottom. Inversely, readings of 80 to 100 can warn of a major top in a stock or index. Combined with RSI bottom readings, we magnify bottom calling frequency. Channeling. During periods of huge volatility and elasticity, channeling can be extremely effective. I typically draw the channel from the way bottom of a wave to the top. If it breaks, it can signal a wave 2 or a corrective wave. But during less volatile markets, the technique is far less effective. The VIX. The VIX has been, in the past 3 to 4 years, somewhat inconsistent indicator after the high period of volatility, 2000-2001. But in 2007, the VIX hit 84 and was a reliable indicator. In 2001, the VIX reached the highs of the crash of 98, the mid to upper 40s, the VIX, and that was one indicator I used in September 2001. Chapter 2. My view of the main points of the Elliott wave principle. The 5-wave pattern. Impulse waves move up 5 waves, if bullish, followed by a 3-wave correction. From my experience, typically in a zigzag form. But Arne Elliott or Robert Prechter, who created the Elliott wave theory, who didn't create the Elliott wave theory, but merely rediscovered it, fails to mention that there are the gap-down rounded bottom wave 2s with no 3-wave formation. They take the form of a U shape and are the most desirable wave 2 formation. Fast, simple, a cup and handle after the first wave. That's what it is. The most frequent wave 2 formations I've seen that work are the ABC zigzag, 3-wave descending pattern, cup and handle, and the ascending triangle. Rarely, if ever, are flats seen in a wave 2. The zigzag is detailed middle. Zigzags are very frequent in wave 2. Extensions. One big thing to note is that in the past 5 to 6 years that I've studied Elliott wave, rarely, if ever, have I seen a wave 1 extension or 5th wave extension. Third wave extensions, the most frequent, are seen from my experience 80% to 90% of the time. Calling a wave 1 extension can be hazardous. Wave 5 extensions typically occur in stock market bubbles, and when they terminate, the corrective wave following can be very nasty, and a fast and violent wave 2 type move. Truncation. Pay special attention to the truncation. Truncation involves a 5th wave hitting the precise top of a 3rd wave and correcting violently in a wave 2, not start of a new downward impulse. 5th wave truncation to the upside are extremely dangerous and have been the downfall of many of my infrequent losses. This one formation is why I try to stress avoiding dreaded 4-5, quote unquote. A 4-5 looks like the third wave can be very tempting. Inversely, a downside fifth wave truncation can be the catalyst for a very swift reversal to the upside. Diagonal triangles. Another very important formation, and very hazardous if you're long or short. This one formation has been the cornerstone for many of my major bottom calls. Bottoms do not end that often with quick violent bursts. They form an ABCDE ending diagonal triangle on low volume with a slow whimper. When it completes, the reversal can be massive. Conversely, an upside leading diagonal can be the catalyst of a major crash. When I've seen them, the corrective wave that follows is far from weak. In fact, before the May 2006 top, this very formation formed ominously and took note of it, avoiding the carnage. Flats. Flats typically occur in the wave 4 of an impulse formation, rarely if ever in the wave 2 position. Flats can be misleading because they can also be a trigger for a fifth wave truncation. The danger of a fifth wave is what keeps me from trading 4-5s. Only when I feel the most fearless, which isn't a good thing. I have never seen an expanded flat myself. Fibonacci is the best measuring stick when a formation gets floppy. Triangles. Most effective triangle formation is the ascending triangle. It can be the catalyst for a very swift upward third wave thrust. Don't depend on them. I've seen them fail miserably. Zigzag and cup and handle flop are the two most effective wave 2 formations. An ascending triangle takes on an ABCDE formation typically in the wave 2 or wave 4 position of an impulse. Combination or orthodox tops. To be quite honest, there are no combination double 3 and triple 3. I have yet to see them out of my countless hours of studies. I've seen an orthodox top once, but taken it once. Orthodox tops form a tiny fourth wave followed by a tiny fifth wave. After the completion, boom, a nasty wave 2 corrective wave. Chapter 3. What needs to be known about Fibonacci and others. You notice on the internet way too many Elliottians who think too hard and label too hard. This is a brain going to the extreme logical side. If you heard of Glenn Neely, he hasn't improved on Elliott wave. He's just trying to make people believe. He butchers it. Many of these Neely disciples spend hours on one chart labeling them with fancy characters X, Y, Z, and garbage that strays away from R.N. Elliott's approach. Typically, they dress up these charts and look complicated and make themselves look good. In reality, it's a pile of horseshit. Also, $2,000 software that makes complications 100 times worse. The best software will spit out as many as 8 different counts, which will confuse you and even make you want to quit. How do I know this? I was a victim of this software and those XYZ people in 2001. I went to an e-signal seminar back in early 2001 when I was learning the Elliott wave. The software labeled the April 2001 drop as a wave 2. I don't want to go any further with this, but this one error created by a machine caused one of my worst trading mistakes ever. Note, Elliott wave is also an art form. When you get to XYZ and $2,000 software, you lost your soul to logic. Visualizing the wave. Software doesn't have human eyes to visualize it, and it will have the aha moment. Here's the point I'm getting at. You'll notice people splitting up Fibonacci numbers into smaller fractals, and even using Fibonacci that's not even close to golden ratio. What I'm stressing about Fibonacci is this. When it's combined with Elliott wave, stick with the golden ratio. Don't divide it up. From my past experience, 50% is non-existent. Don't even bother to look for them. 0.236 almost never happens, and 0.786 went from a working ratio to almost an obsolete number. Those numbers are the impatient Fibonacci numbers. Traders want to trade, so they're willing to accept those numbers. Don't even bother. What you look for is purity, the golden ratio. These are the numbers. 1.00, 0.618, 0.382, 1.618, and 2.618. When I follow the pure Fibonacci fractals, I can find the most definitive moves in each wave. That's it. You thought it was more than you did. You thought that it was more than that, didn't you? When you see the purity, things start to open up, big time. Like clear spirals from the sky. You see it. That's the wave count. Once you see it, you see the pattern, or in my case, the V pattern. Chapter 4. predicting tops and bottoms of Fibonacci numbers. Here's what everybody wants to know. How do I predict bottoms at the exact day, or how did I? I was messing around with my favorite charting software, BigCharts.com. It's the only website-based charting software I've ever needed, and it's free. I decided to analyze all the major bottoms since the 1970s, including 1974, and I started noticing something. The spirals were very distinct. When I candlelized them, my eyes widened. Fibonacci was everywhere. I started counting from major bottoms to tops. I noticed that each bottom to top was between 55 or 89 Fibonacci days. Blew it up, 55 or 89 Fibonacci months. It only took one time for me to see this. I spent the entire night looking at all the instances of this from the bottom of 74 to present. It happened repeatedly. It was so mind-blowing to me. I started to also notice Fibonacci number 34 appeared during short corrections. Those are the three numbers that worked: 34, 55, 89. 13 and 21 is very lazy, and 144 can be split up into 55 and 89. Since its discovery, I noticed a more frequent occurrence of 55 and 89. 55 has been happening very frequently in the past 5 to 6 years. However, there's a big catch. You have to be able to spot when these five-way formations complete up or down, or when the zigzags complete up or down. Fibonacci doesn't work by itself. Combined with Elliott waves is where you get the accuracy. It's no secret to me about 55 and 89, but it's tough for others to spot it, and they can't find where five waves up or down or the zigzags complete. I hate having excess garbage information to carry around. I love to narrow things down to one or two. To me, one or two is 55 and 89, and 0.618 and 0.382. Two major forms of technical analysis also come into play, or came into play in each of my major bottom calls. Slow stochastic at bottom readings and the RSI at bottom readings. Take those two, add high put call ratios and end diagonal, and wham, you've seen and predicted a bottom. Chapter 5, Trading System. Before I get into it, please do not try this at home thinking that you spotted it after reading this one page. There are waves that I call 4-5s that you can run into that I avoid. 4-5 is a sucker play. You do not want to be facing a 4-5. I stress that if you want to trade these setups, you must listen to what I have to say about it, which is why many of my subscribers are still subscribers after 3+ years. These setups have very intense technical requirements. You can't just jump into the market thinking you know it. My trading is a high level of precision. I will not allow a trigger to trigger buy below my trigger price period, even with 0.25 with the target. Also, NASDAQ needs to be at a certain level at 3 to 4 p.m., reasonable slow stochastic, natural buying without forced buying waves, depth of the corrective must be exact, a zigzag, etc. The list goes on and on. I have been the eyes of many subscribers for years. Elliott wave is just not a science. It's an art as well. I typically give the last word on each trade. All you have to do is post to the board or talk to me in the chat room, and I'll let you know what I think. Subscribers who listen to me very closely have done very well. I've heard stories of guys who listen very carefully to my words. One of them I heard turned $100,000 into $250,000 in just 3 months, with just my approach. I didn't have one loss. He caught one of my streaks and was, well, very happy. I can go on and on, but these are just a couple examples. Recently, I've learned to trade consistent profits with more exotic trading vehicles, options or leaps in Forex. For years, it was just stocks. Now the door has just opened up. The system is based on trading on the best Elliott wave pressure points that I call the pattern. It works 80% of the time, which is why I'm 80% profitable on all my trades. Sometimes I'll see the pattern so frequently that I can go on streaks. Many subscribers know this is the Joe DiMaggio mode. 25 profitable in a row, 14 here, 12 there, 16 again. Other sites have been created on my system. They subscribe for a few months and run off and create their own website, and they still can't get it right. One competitor charges $249 a month to have 55% profitable trades, 40 trades a month. Sad. This will drive you crazy. Catch them on a wrong month, and you're 40% down in the hole. I'm very consistent and very anal with my trades. Picking your spots. The most important part of trying to become a master trader. My trades are very secure. You'll know where to buy and where to sell, with a stop loss at a precise Fibonacci level, and what to expect. Expect at least 10 to 12 of these trades set up for trigger per month. Here is the bonus section of the Wave Genius audio ebook. This is the top 40 stocks updated October of 2009. The first stock is IBM. Best case scenario is that IBM could form a 3 from heaven as 2.618 times wave 1 to 153 to 155. Probability is 55% chance it's in the best case scenario. Starbucks, SBUX. The best case scenario is that Starbucks has entered a wave 3. It would target as high as 25 to 26, 1.618 times wave 1. The worst case scenario is that Starbucks is top tier in an upward ABC of 2021. There's a 75% chance they hit the best case scenario. MasterCard, or MA. The best case scenario for MasterCard is that MA would rally to as high as 270 in a wave 3. The worst case scenario is that MA has topped out here in an upward ABC. There's an 80% chance that it's in the best case scenario. Bank of America. Best case scenario for Bank of America. If it's in an upward 3, it could target as high as 30 to 31. The worst case scenario for Bank of America. If it's an upward ABC, the highest it would go is 20 to 22, or falling into 5. Probability is 65% chances in the worst case scenario. Visa, or V. The best case scenario for V. V is in an upward 3, which could target as high as 110 to 115, with 1.618 times wave 1. The worst case scenario for V. V is in an upward ABC, which targets as high as 85 to 90 max. Probability, 75% chances in the worst case scenario. ISRG. Best case scenario for ISRG. ISRG is in a wave 3, which could hit as high as 280 to 290. The worst case scenario for ISRG is not applicable. There's 90% chances in the best case scenario. eBay. Best case scenario for eBay. It's in an upward 3, which targets as high as 30 to 31. The worst case scenario for eBay is topped out right here where it is in upward ABC. The 70% chances in the best case scenario. Sino. Best case scenario for Sino. It's in an upward 3, which will target as high as 54 to 55 with 1.618 times wave 1. The worst case scenario for Sino would target as high as 43 to 44 max before correcting in a wave 4. It would be in an upward ABC. Probability 50%. For Sohu, SOHU. Best case scenario for Sohu. It breaks 73 and forms at least an upward C to as high as 85. There's a 60% chances in the best case scenario. NetEase, NTES. Best case scenario for NTES. It closes above 47 and rallies in an upward 3 to as high as 75 to 80. The worst case scenario, it drops to as low as 28 to 30 in a wave 2. Probability undetermined. Apple, AAPL. Best case scenario for Apple is that it's an upward 3 to as high as 400. The worst case scenario for Apple is an upward ABC to 275 max. There's an 80% chance in the best case scenario. Google, GOOG. Best case scenario for Google is that it's in a full upward 3 to as high as 670. The worst case scenario is not applicable. There's an 80% chances in the best case scenario. Cisco. Best case scenario for Cisco is that it's in an upward 3 to in green, an upward 3 to as high as 28 to 30. Worst case scenario is that it tops out at the ABC target of 2470. There's a 70% chance that it's in the best case scenario. For SanDisk, SNDK. Best case scenario for SanDisk is that it's an upward 3 to in green is an upward 3 to as high as 25 to 26. Worst case scenario is not applicable. There's 70% chances in the best case scenario. NVIDIA. Best case scenario for NVIDIA is in a wave 4 which holds 13 and rallies back over 1650. Worst case scenario for NVIDIA is not applicable. There's a 60% chances in the best case scenario. Baidu. The best case scenario for Baidu is in a wave 3 on the 5-year chart. The target is high as 700 to 720 of 1.68 times wave 1. There's an 80% chance that this could happen. for RIM. Best case scenario for RIM is that it's in a wave 2 that holds 53 to 55. The worst case scenario for RIM is that it breaks 53 to 55 and drops as low as 45. Probability undetermined. URBN, urban. Best case scenario for URBN is an upward 3 to 36 max. There's an 80% chances in the best case scenario. Costco, COST. Best case scenario for Costco is an upward 3 to as high as 65 max. There's an 80% chances in the best case scenario. ESRX. Best case scenario for ESRX is that it's in a wave 3 that would target as high as 95 if 1.618 times wave 1. There's an 80% chance in the best case scenario. Amazon. Best case scenario is that it's in a wave 3 could target as high as 160. Probability, best case, 80%. F5. Best case scenario for FFIV. FFIV is an upward 3 in green, with target as high as 65 or 1.618 times wave 1 in gray. Worst case scenario, 52 max in an upward ABC. Probability, 80% chance in the best case scenario to 65. FISV. Best case scenario for FISV. It breaks 51 and rallies to as high as 80 in a wave 3. Worst case is a break at 51, and the rally would target as high as 55 max. Probability 50-50. X-ray. Best case scenario for X-ray. The highest target would be as high as 43 to 45 in a wave 3. Worst case scenario is an upward ABC to 37 max. There's 70% chances in the best case scenario. NIHD. Best case scenario for NIHD. That is in a wave 4 that would correct to 28 to 29 and form a 5 up that breaks 35 and heads towards 40 to 42. There's an 80% chance in the best case scenario. MICC. Best case scenario for MICC. Best case scenario is that it's in a wave 2. It'll break 79 and rally to as high as 140 in a wave 3. Worst case scenario for MICC. The area in yellow is there that is in wave 4 and it'll hit 90 max. WIN. WYNN. The best case scenario for WIN that is in a wave 4. It would hold 57 and rally back over 75 and form a 5th wave up to as high as 90. Worst case scenario is that 57 breaks and drops in the wave 2 to as low as 45. Probability 50-50. WFMI. Best case scenario for WFMI. The area would target as high as 41 to 42 in a wave 3. There's an 80% chance it's in the best case scenario. PCAR. Best case scenario for PCAR is that it's an upward ABC to as high as 44 to 45. There's an 80% chance that this happens. PETM. Best case for PETM, an upward ABC to as high as 30 max. There's an 80% chance in the best case scenario. Akamai. AKAM. The best case scenario for Akamai is that 2350 breaks to the upside and it forms an upward 3 as high as 38 to 40. Worst case scenario for Akamai is a break below 18 forming a downward C. There's 70% chance in the best case scenario. Amgen. Best case scenario for Amgen, AMGN. It holds 0.618 at 52 and rallies back over 64, forming a 3rd wave. The worst case scenario for Amgen is 52 breaks and tests 45. There's 70% chances in the best case scenario. Celgene, CELG. Best case scenario for CELG is 58-20 breaks and it forms an upward 3 to as high as 80. Worst case scenario for Celgene is in a 5th wave up to 64 max. There's 70% chance in the best case scenario. Adobe. Best case scenario for Adobe is an upward ABC to as high as 40 to 41. There's an 80% chance that this happens. Joy G. Joy Global. Best case scenario for Joy G, it's in a wave 3 to as high as 75 if 1.618 times wave 1. There's an 80% chance this happens. PTEN is that it's in a wave 3 as high as 25. There's an 80% chance that this happens. SLB is that is best case scenario for SLB is that it's an upward 3 to as high as 95 to 100. The worst case scenario for SLB is an upward ABC to 75 max. The 50% chance. JP Morgan, JPM. Best case scenario for JPM is that it's in a wave 3 to as high as 70. The worst case scenario is that there's an upward ABC to as high as 55. Probability not applicable. Goldman Sachs, finally. Best case scenario for GS, it breaks 0.786 at 204 and rallies over 248 and a new high. Probability 80%. These 40 stocks will be updated every 6 months, 3 to 6 months. So look out. So be on the lookout for them to come out. Thank you, and hope you enjoyed the ebook.